Daniel. Or Danielle.
It's Daniel.
Daniel.
Yeah.
Dan, party foul. No location given.
No location given.
See, we're going to stop answering your
Question unless you
questions.
tell us where you're from.
Yeah.
Just make something up, or else I will.
Where do you think he's from?
Dan?
Yeah.
Oh, I don't know.
Los Angeles?
No,
No.
I don't think so.
No.
No. Little Rock, Arkansas.
Okay.
I have a significant amount of taxable capital gains in my portfolio. Is there any way to reduce the taxes on my portfolio so I can modify my investments? Thank you for any advice you can provide. So he's got significant amount of taxable capital gains in my portfolio.
So there's a couple ways you could answer that question. I would say I'll start with the first way I think.
Well, congratulations, you made money.
Yes, right.
Pay the tax and move on.
We could do better than that. So one way we could take this question is he's talking about he's got a lot of taxable dividends, right? In other words, maybe he got into some high dividend paying stocks, and so, or maybe he's in actively traded mutual funds.
Oh, you think that's his question?
Well, that's one way to answer it, and then the other answer is probably what you're thinking, which is he's got gains in his portfolio.
Okay, yeah,
So
let's go both ways.
yeah.
I like your style.
So I'll start with the first one.
All right.
The first one is when you have investments outside of retirement, particularly like if it's a mutual fund or index fund, that particular fund is going to have assets, stock, for example, stock certificates, and those stock certificates, they're interest in companies that pay dividends. And those dividends actually come to you, and they typically come to you once a quarter, and you have to pay taxes on them, and then typically there's some buys and sells inside the mutual fund. Those are called capital gain dividends, and that tends to happen in December. In general, it could be different, but that's most commonly. And so there are certain mutual funds that are tax efficient and certain ones that are not. And the ones that are tax efficient tend to be more like index type funds, where like the S&P 500, where it's just mirroring an index, and so there's not a lot of buys
Trading,
and sells,
yeah.
right? And then it's kind of a cross section of companies. Some are higher dividend stocks, some are lower dividend paying stocks, as opposed to there are mutual funds that have high dividend paying stock companies. And so all of a sudden it's like, even if you don't need the money, even if you're reinvesting that money to buy more shares, you're paying taxes as you go, which isn't very tax efficient.
Yeah, it's a tax drag.
Right. Yeah. So if that's the question, then it's very simple. You just switch to some of your investments that are generating a lot of dividends, and switch to ones that would generate less dividends. Maybe even go to municipal bonds, which is tax-free interest. There's ways to reduce the income that you actually pay.
Yeah, I think you look at the type of fund that you're in. If it's actively traded fund, if it's a actively managed mutual fund, you're going to see a lot more turnover in those funds. That will kick out more types of interest and dividends, capital gains that you'll pay tax on, even if you're reinvesting.
Yeah, and worst comes to worst is if you buy into that fund in, let's say, early December, and then they have this big capital gain distribution, and so you're basically paying tax on, in essence, everyone else's gain over the last year.
And be careful also with those types of investments, because we've seen where the investment actually went down in value and you still got a tax bill.
Sure.
So just understand what you're holding outside of retirement accounts to be a little bit more tax sensitive. So.
Now, for those of you that are worried about that, it does work out in the end, because when you pay tax on this, it increases your tax basis so that when you sell that investment, there'll be less gain.
Yeah, but there's also times, too, is that, the mutual fund manager is buying and selling stocks, and they have their own cost basis within the stock, within the fund. And let's say your mutual fund NAV price is at $20 a share, and the market tanks and it goes to 10, you still might have to pay tax on a totally different basis within the fund.
You could, because they
could have been trading,
because
right?
they're issuing the capital gain dividends based upon their basis inside.
Right.
Wow, now you got really technical.
Yeah.
Look at you.
Yeah. Right. So
that is correct.
It wouldn't work out. It wouldn't even
Yeah.
out. Where I think what you were referring to is, let's say if I had $1 dividend and my stock price went down, well, it's the same.
Yeah. I mean, in essence, you're basically prepaying a tax that you don't necessarily have to pay till later when you actually sell that investment. So that's one way to answer the question.
All right.
The other way, which I think where you went, which is where I went originally too, which is maybe inside his non-qualified or non-retirement investments, there is significant gain. He bought some stock at $10,000, now it's worth $20,000, or he bought it at $50,000, now it's worth $200,000, whatever. And it's like, gosh, I'd like to take some of these profits, but there's a lot of gain in there.
Yeah, it's like, well, I don't want to sell this. So our advice is always, you want to make sure that you have the appropriate diversified portfolio given what you're trying to accomplish. And if you have to pay a little bit of tax, so be it. There's strategies, though, long-term to reduce some of that bite, right? Because if I'm just holding on one security, for those of you that like to buy individual stocks, it's very, very difficult to do any type of active tax management within it, such as tax loss harvesting, right? Because if I have a gain in one stock, and if I have a loss in another, I could potentially offset that gain with that loss. So you have to look at the portfolio and how many investments that you actually own, how diversified are you, and then there's some active tax strategies that you could do along the way. So if I sold now and had a tax bill, I still have another 7 months, let's say, of the market, and look at how volatile the market's been. There could be ways to sell a security at a different price, right, and harvest some of those losses to offset some of those gains.
Yeah, and those losses, we're talking capital losses. So let's say you sold a security or investment and have a big gain, and you did it right now. And as you say, you've got another 7 months in the year. You've got other investments, and let's say in the next 7 months, some of those go down in value. You can actually sell one of those, and that capital loss nets against the capital gain dollar for dollar. A lot of people don't realize that. A lot of people think you only get to take $3,000. That $3,000 rule is against ordinary income. But when it's a capital gain versus a capital loss, those offset dollar for dollar. And in fact, if you've got a bunch of capital losses that you haven't been able to use in the past, they carry forward, and you can use those dollar for dollar against the gain. So that's one strategy. And another one, Joe, I think is we see this when people have a number of positions, but they want to diversify better. Maybe they have a lot of individual securities. And then what we typically do, we kind of put together a little spreadsheet that shows the amount of the value of each stock versus the amount of the gain, and then we come up with a percentage, and then we do the lowest gain percentages to the highest gain percentages, and then we just have a running total. And in many cases, a portfolio of, let's just say, $500,000 of stock, you might be able to sell $300,000 of it and rebalance and not pay any tax if there's not a lot of gain, or maybe there's some losses in some positions. And then maybe that last couple 100,000 of positions have bigger gain. Then maybe you slowly bleed that out over time.
Yeah.
So that would be a strategy as well.
Right, or you could do the opposite, where maybe you have two positions that have large gains, and you say, you know what, I'm ride this pony long enough.
Yeah.
Where then you say, okay, well, maybe you sell those, diversify a little bit more, and then the rest of the portfolio, you kind of take a look and bleed those out. But here's the problem: is that I think we look so often at buying and selling investments because of fear agreed within the overall marketplace, versus looking at a sophisticated tax strategy to make sure that you're keeping everything that you possibly can and reducing your tax bill as much as you can.